Good morning. This is Larry McMillan with a stock market update on Monday, January 6th. Happy New Year to everyone. So the market's off to a wild start, a volatile start. We had some selling at the end of the year. When the new year started, a big rally took place, immediately was squashed, and the market traded all the way down to support right around 58.70. It closed very close to that. And then a huge rally has taken place since then. So we've basically traversed and retraversed and even once more traversed that range between 58.70 and the old highs near 6,100 about 3 times now in the last month, maybe 4 if you want to count the first time up. So it's a trading range. We've been volatile within that trading range. The main thing I think to take away from this is that S&P has held that support at 58.70 on a closing basis. And so we're still holding a core bullish position because of that. We probed down to 58.30 twice intraday and held there as well. So that might be an intraday support level. But the 58.71 seems to be the one that people are looking at. So for now, it's still a bullish market. Obviously, we've now come up all the way up to resistance at 60.10, and that resistance exists all the way up through the old highs at 6,100. So we'll see if that's going to retard the advance once again. Equity-only put-call ratios are still on sell signals. Our market internals are mixed in here. Typically, when the internals are mixed, but the S&P is positive, you go with the S&P. So this is a negative market internal, the put-call ratios. Breadth, however, has improved. In fact, probably at today's close, I mean, I can't predict exactly, but at today's close, we'll have buy signals from our breadth oscillators for the first time in quite a while. Breadth has been a problem for the market really since, well, shortly after the election. So maybe things will be turning around there. New highs versus new lows, that's still a negative indicator as new lows continue to register above new highs, not by a lot, but by enough to keep this indicator negative. VIX itself has spiked up last week on that sell-off and then back down again. So we actually have a second spike peak buy signal in place. That's rare, but we only trade the first one. The first one occurred back on December 19th. This one is just sort of, frosting on the cake. So that indicator is still positive. And if VIX closes below its 200-day moving average, at least convincingly below, that moving average is at 16 roughly, then that would also be bullish for stocks as well. The construct of volatility derivatives, in other words, the term structure of the VIX futures and the CBOE volatility indices, that construct remains positive in its outlook for stocks. So as I said, the indicators are somewhat mixed, but the fact that the index itself is holding above support at 58.70 is the most important thing that I'm seeing right now. So I invite you to visit our website, take a look at our newsletters. We still have some specials going on, some year-end specials in terms of pricing. And meanwhile, have a great week trading.